Want to start investing in 2025 but feel overwhelmed by jargon and fear of losing money? You're not alone. The truth is, for most beginners, the best investment strategy is simple. No risky stock picks or day trading required. It's about building a solid, consistent foundation that quietly grows your wealth in the background. In this video, I'll show you the only strategy you need to confidently start investing and set yourself up for long-term success. We'll cover everything from setting goals to choosing the right accounts and investments. By the end, you'll have a clear, actionable plan. No more confusion or analysis paralysis. So grab your coffee, hit that like button, and let's dive into the only investment strategy you'll need for 2025 and beyond. Before you invest $1, ask yourself, why are you investing? Your goals are the foundation of your entire strategy. Without them, you're just wandering aimlessly. Are you saving for retirement, a house, or financial freedom? Each goal needs a different approach. Your timeline and risk tolerance depend on your goal. Long-term, you can take more risk. Short-term, play it safe. Don't copy someone else's portfolio. Your goals are unique. Get specific. How much do you need and by when? Write it down. For example, I want $50,000 for a house by 2030, or $1.5 million for retirement by 65. This clarity keeps you focused and motivated, especially when markets get rough. Investing becomes more meaningful when you're funding your future, not just an account. So pause if you need to and define your goals now. What are you investing for? What's your timeline? Be detailed. This step puts you ahead of most beginners and sets the stage for everything else. Don't skip it. It's the most important part of your journey. Now let's talk about your greatest ally, compound interest. It's simple. Your money earns returns and those returns earn more returns, snowballing over time. For example, invest $1,000 at 10%. Year 1, you have $1,100. Year 2, $1,210, and so on. The real magic happens over decades, not years. The earlier you start, the more time your money has to grow. Consider Sarah, who invests $200/month at 25, and Ben, who starts at 35. By 65, Sarah has over $700,000. Ben, just $300,000. Waiting for the perfect time to start is the biggest mistake. Time in the market beats timing the market. Compound interest grows exponentially, not linearly. The biggest gains come later, thanks to early consistency. Don't chase hot stocks. Focus on steady long-term growth. Even small, regular investments add up. $50, $100, or $500 a month, just start. Automate your contributions and let time do the work. Consistency and patience are what separates successful investors from the rest. Compound interest is your secret weapon. Use it. Don't worry about starting small, just start. The habit matters more than the amount. Let your money work for you, quietly, every day. So what should you actually invest in? Forget picking individual stocks. Most people lose that game. Your best bet: low-cost index funds and ETFs. Index funds track a whole market, like the S&P 500, giving you instant diversification. If one company tanks, hundreds of others balance it out. ETFs work similarly, but trade like stocks, easy to buy and sell. Both options are simple, effective, and require little research. The real advantage? Ultra-low fees. Over decades, high fees can eat away at your returns. Index funds and ETFs are passively managed, so you keep more of your money. This approach removes guesswork and emotion. You're betting on the market, not a single company. Even Warren Buffett recommends this strategy for most investors. Start with an S&P 500 or total market index fund, and add international funds as you grow. Keep it simple, broad, and low cost. This is the proven path to long-term wealth. Now, how do you actually invest? Enter dollar cost averaging, or DCA. DCA means investing a fixed amount at regular intervals no matter what the market's doing. Set up an automatic transfer, $200 a month for example, and let it run. Sometimes you'll buy when prices are high, sometimes low, but over time you average out your cost. The real power is psychological. You remove emotion and avoid trying to time the market. DCA keeps you disciplined and consistent, the true keys to investing success. Think of it as leaving a bucket outside to collect rain. You don't chase every storm, you just let it fill up over time. Decide what you can invest each month, automate it, and stick to the plan. Don't stress about market ups and downs, just keep investing. Automation beats endless market predictions. Consistency wins the long game. Where you invest matters as much as what you invest in. Use tax-advantaged accounts to supercharge your growth. Start with your 401k, especially if your employer offers a match. That's free money, don't leave it on the table. After getting the full match, open an IRA, either traditional or Roth. Roth IRAs are especially powerful for young investors. Pay taxes now. Let your money grow tax-free and withdraw tax-free in retirement. Max out your IRA contributions if you can. If you still have money to invest, go back and add more to your 401k until you hit the annual limit. Only after maxing out these accounts should you invest in a regular brokerage account. This order maximizes your tax savings and long-term returns. Remember, tax-advantaged accounts are your secret weapon. Use them to keep more of your money working for you. Don't miss out on free money or tax-free growth. Set your contributions on autopilot. This is how you build wealth efficiently. Before you invest, build an emergency fund. This is your financial safety net. Life throws curveballs: job loss, medical bills, car repairs. Without a cash buffer, you might be forced to sell investments at the worst time. Aim for 3-6 months of essential expenses in a high-yield savings account. Calculate your must-pay bills, multiply by 3-6, and set that as your target. Keep this money safe and accessible, not in the stock market. Only start investing seriously once your emergency fund is in place. If you don't have one, pause investments, except for a 401k match, and save aggressively. This step protects your long-term plan from life's surprises. It's not falling behind, it's building a strong foundation. Once your fund is set, invest with confidence. The hardest part of investing? Sticking to your plan for decades, not months. Ignore the financial news hype. Crises and hot tips are designed to make you act impulsively. The market will have ups and downs, but the long-term trend is up. Don't panic during downturns. The best investors hold steady and keep buying. Check your portfolio only a few times a year. Less is more. Your goals are your anchor. When markets get rough, revisit them. Remember, you're investing for the long haul: retirement, a house, or financial freedom. Don't let short-term noise derail your strategy. Commit to your plan for 2025, 2035, and beyond. Patience and discipline are your greatest assets. The biggest mistake? Trying to time the market. Even the pros can't do it consistently, and missing just a few of the best days can destroy your returns. Studies show, stay invested and your money grows. Try to jump in and out and you'll likely lose. Dollar cost averaging is the antidote. Invest regularly, no matter what. Don't let fear or headlines push you to sell or wait on the sidelines. The best time to invest was yesterday. The second best is today. Make a pact. No market timing, no panic selling. Stick to your automated plan and let time work its magic. It's about time in the market, not timing the market. Embrace this, and you'll be a more successful and less stressed investor. Here's a simple trick to boost your returns. Reinvest your dividends. When your investments pay out dividends, use them to buy more shares automatically. This creates a compounding effect. More shares mean bigger future dividends, which buy even more shares. Most brokerages let you turn on automatic dividend reinvestment, DRIP, with one click. Over decades, reinvesting dividends can make a huge difference. Up to 40% of total returns in the S&P 500 come from dividends. Don't take the cash, let it grow. Set it and forget it. Your money keeps working for you. This is a key part of a truly passive, powerful investment strategy. Make sure it's enabled for all your accounts. That's your 2025 investment strategy. Simple, automated, and built for long-term success. Set clear goals, harness compound interest, and focus on low-cost, diversified index funds. Use dollar cost averaging, maximize tax-advantaged accounts, and build your emergency fund first. Tune out the noise, avoid market timing, and reinvest your dividends. Boring is good. Boring builds wealth. Start now, stick to your plan, and let 2025 be the year you take control of your financial future. Like, comment, and subscribe. Let's grow together.